Hello everyone, welcome back to part 2 of our explanation of tax credits. We left off in the middle of discussing the AOTC and the lifetime learning credit. Before we go on and look at phase outs, just a reminder, update. AOTC is 40% refundable, 60% non-refundable, while the lifetime learning credit is all non-refundable. So that's how those fit in our earlier classification, something to remember. So looking at these, there is a phase out, and unfortunately there is a different phase out for each of these credits. We couldn't agree and have it the same for these two kind of related credits. So there's a phase out for the AOTC. For single, starts at 80 completely. See, it's a $10,000 phase out range. If you're below 80, then you get the full credit, okay, that you calculated. If you're over 90, you get 0, and in between you get the portion that you are under the phase out range, or you can subtract the amount of percentage that you're over the 80,000, however you want to figure that. And for married filing jointly, it's a 20,000 range that starts at 160. Right, so it phases out over a broader range of income. For the lifetime learning credit, it's lower, 58 up to 68 for single and 116 to 36, same range size, but it starts lower. Okay, so you're completely out of the credit. It doesn't do you any good if you're over 136,000 if you're married filing jointly. So how do you figure out the amount? This calculates how much of the credit you get to keep, right? So if you take and you subtract, you're only applying this if you're AGI or modified AGI, and the only modification is some foreign source income issues, but is you take the difference between what your AGI is and the 180,000 and then divide it by the range to 20,000, and that's how much you get to keep. So you're under the threshold or under the maximum part of the threshold by whatever percentage this is when you calculate it. And that's how much you get to actually use. So you would then take this percentage, multiply it by the amount of the credit, and that's what you would actually get to take the benefit of. This is the formula for the lifetime learning. Same idea. This gives you, when you calculate it, percentage you get to keep. All right. So single taxpayer paid $2,900. How much is the lifetime learning credit? Okay. Now, first of all, first thought about this, we probably should be doing the AOTC because this qualifies for that. And remember, it's better but it's limited to the first 4 years of education, and they have to be at least a full half-time student. Well, Jules qualifies under both of these. So really this should be AOTC unless there was some other reason why she was disqualified, but it looks generally that she would qualify. But if she didn't, then the lifetime learning credit would be just 20% of 580. If this was the AOTC, if she did actually qualify, then it would be you'd have the 100% of the first 2,000, okay? And then 25% of the next 900. So it'd be a lot bigger credit than the lifetime learning credit. So this time the AGI is 85,000. The last one we did it without considering AGI, okay? And this just the time she is going to take the AOTC. 100%, 2,000, 25% of the next is for a maximum of 2225. This is, though, subject to our phase out. Subject to the phase out, subject according to this formula that we showed you earlier. So they would only be able to take the credit of this amount. And remember, this would be partially refundable and partially non-refundable. Foreign tax credit. This idea is we're going to give you a credit for the tax you paid on income you earned somewhere else. So you live in the United States, but let's say you have a business interest or something in another country, you earn income there, there's investment there, whatever, that you earn interest, and like the government there socks you with a tax bill, okay? So the idea here is you're not going to have to pay taxes there and in the United States on the same income, okay? So what you do is you know how much you paid on that income in the other country. You look at how much you would have paid if you had earned that same income in the United States, and then your credit is the lower of those two numbers, okay? That's basically the idea. So this is how you calculate it. You take your foreign source taxable income, divide by all of your taxable income. You multiply that by your tax liability, what you owe on all your income. So you first calculate your tax on all your income, okay? So then that's the income that's attributed to that foreign income. That tax is attributable to that foreign income. All right, so you can either then that amount compared to what you actually paid, the lower of those two amounts is your credit. So it is available to any taxpayers who pay foreign income taxes. If that investment or something you didn't get charged taxes on it, then this doesn't come into play. So it's only if you've actually paid taxes in a foreign jurisdiction. So example, 63,000 worldwide taxable income, 8,000 from New Zealand. She paid 2,500 to New Zealand. Her tax liability here is 17,640 on the whole amount. So she takes 8 divided by 63, multiplies it by the whole amount. That's how much she gets. That's how much she would pay. Whoops. That's how much of her tax is from the income from New Zealand. But she paid 2,500. She has to use the lower one. The only credit she gets is for the tax she would have paid, part of the tax that she paid in the United States for that income overseas. She doesn't get the full 2,500. All right, child tax credit. This is perhaps your most common credit that you're going to run into. And this one is also can be refundable. Usually is if they have enough earned income. So that is typically refundable, but it also you have to apply it non-refundable first. So it always applies to your tax liability, and then it carries over and it could end up in a refund. So what is it for? Qualifying children under 17, U.S. resident, have to be younger. It's $2,000. It's double what it was a couple years ago. Does get phased out, but at very high rates. It is refundable up to $1,400 per child, okay, if you have enough income. But that is the most. So remember, notice that you're not going to get all of it refundable, no matter what the situation. And then you also have a $500 non-refundable credit, kind of separate but related. Is still considered the child tax credit for qualifying dependents or other than children. Okay, so they're under 17. So the children that get over 17 or 18 get over 17 can still be the $500. All right. Phase out pretty high AGI compared to our other ones we've come across so far. Phase out 400,000 starts, 200,000 for everybody else. Notice that it's not a range. Okay, so this is a different kind of phase out than we looked at with the other credits. It's $50 for every $1,000 or a fraction thereof in excess of the 400,000. So you go over your 400,000 AGI, you take the amount you're over that, you divide it by 1,000, round up, no matter what the number is, and then multiply it by $50, and that's how much your tax credit is reduced. So you subtract that amount from whatever you came up with. You had 3 kids, $2,000 each, 6,000. You start subtracting $50, and you see that eventually you do lose that. It does phase out. So here's an example. We're over by 17,000. All right. So we take 17, we times by 50, we get 850. Our initial calculation was 2,000. Okay, we subtract the 850, and so we would only get to keep or use 1150 of our tax credit. All right, retirement savings contribution credit. This is one of the few places in the tax law where you actually get to what I refer to as double dipping. You get 2 benefits. Whenever you have money taken out or you make a contribution to these regular retirement accounts, you get to take a deduction for the amount you put in. Meaning, for your employer, if you put it in a 401k, it comes off of your W-2 income. It doesn't even get reported. It's not included in income. Anything that's put into your account, you put in contributions. If you make a contribution to an IRA, independent of your employer, that amount is deductible as a 4 AGI deduction. Okay, so you've got one benefit from doing that. In addition, you can get this credit, maximum up to $2,000 per person. Okay, this is individually, each taxpayer separate, looked at. Okay, based on your AGI and a percentage, you get a separate credit on top of the deduction you already got. So like I said, this is one of the few places. This usually doesn't happen. You either got to pick one or the other, deduction or this way you can get a deduction and a credit for the same dollars. Okay, so here's how you calculate it. You know how much you put in. Okay, you look at your AGI where it falls, and then this is the percentage that you get as a credit of what you put in. So the amount you contributed. So if you put in $1,000 and your income's, you're a joint filer and your income's under 38.5, then you get a credit for half of that. If it's between these two numbers, which is not a very big range, it's 20%. A little bigger range here, 10%. And notice that at 64,000, it's gone. That's a very low. So while this is a nice benefit and double dipping, it goes away very quickly in terms of income. So, have AGI 52, married, filing jointly, contribute $1,500 during the year. 1,500 times 10% based on the chart we looked at. Okay, under 64,000, $150 credit. Roger, much lower AGI, made 2,200, so he's entitled to 50%. But remember, it's maximum $2,000 contributed can be considered. So only his credit is $1,000. That's in addition to the deduction that he would have for this 2,200. Adoption credit, much more rare, but it is there. You should know about it. 100% of the qualified in the year that it is finalized. $14,080 per child is the maximum credit. This is dollar for dollar the cost you spend. It's not a percentage. All right, but it does phase out. They're pretty high, but you're looking at where you are. The phase out range is bigger than what we looked at before. This is how you calculate how much you get to keep of the credit based on AGI. So that's for adoption. That's for the cost of funding the adoption, all the legal fees, all the kinds of things it would take to make an adoption. You can tell the kinds of things, and this is non-refundable, you can tell the kinds of things that Congress thinks we should be doing more of by what they give us a credit for. Okay, adoption is one of those things that you might say is politically favorable. So we're going to end part 2 there and finish up with the earned income credit in part 3.